Hello everyone, Andrew Daco here from TNT Group. I got George Cavaligos to my right from MF Global. We got Brian Tahaco from TNT Group as well. Doing another installation of the one-on-one trader talk. We haven't done one in a while, but since then there kind of has been quite a bit of news, I guess, going on. We did see last Friday the unemployment number. The estimate for the non-farm payrolls was 150K positive. The actual number came out positive 39K. The rate came in at 9.8% versus an estimate of 9.6%. So some pretty bad numbers. You guys have any thoughts on it? George, we'll start off.
Well, another jobless recovery for the U.S. economy. The Fed's trying to do everything that they can. Now we need some help from our administration and Congress. Nothing's really going to happen there, unfortunately, until we get the new Congress put in January and we get some, hopefully, progress on the fiscal side of the ledger. The monetary authorities have done everything they can. It's not working very well, as we've seen with the sell-off in the bond market. QE2, I think, has cushioned the downside for all these markets. It's tough being short at times because there's sort of this underlying flood of liquidity from the Fed. And it's pumping up commodities. If you want to be long, I think you got to be long commodities still. I love being long commodities. The agricultural commodities have performed very well. The crude oil has performed very well. I think barring any further surprises, those trades will continue to work. I still like selling rallies in the credit markets here. The email that I put out this morning, I pointed out the possibility of a potential double bottom in the bonds. But I'm not a firm believer in that. I do want to keep selling rallies until I'm proven wrong on the bonds and notes.
Right? My notes.
The unemployment number, I think, was a shock. It was a shock to me. Just kind of the way that the market had traded up into the number. It seemed like they were expecting a good number. And I was thinking it was coming out around 250,000, somewhere around that, possibly even over 300, which seemed like what would have been priced in. Was a 34. Was, I mean, just incredibly bad, and it's just basically proving that we're creating money, we're printing money, but there's nothing that they can do to support job growth. I mean, there's nothing that the government can do unless they went out and basically created their own job growth by building new bridges and hiring people, construction, and doing that whole non-government or government employee type stuff. That's the only way that they can create jobs, and this is just proving it. It's not creating anything new. It's not creating new businesses. It's not creating a stimulus, I mean, in the housing market, which is, you know, especially where I live in the south suburbs and stuff like that, that's what their stimulus was. It was construction. It was building new homes. It was flipping houses. It was all that. That was a huge job, and those people are pretty much out of work, and you're not going to recreate that stimulus where people are going to be building new homes and doing all that. So that's gone, and I think until the government realizes that they can do all the QE they want, it's just not going to create that job growth, which is what they need, and I think that number just basically proved it on Friday.
Okay, you mentioned kind of the printing of money. We saw Ben Bernanke come out on Friday late in the afternoon, probably when most traders are actually done. Then again on Sunday, he was on 60 Minutes, and he talked a lot about possibly decreasing or increasing in ability to with the bond purchase program. Now, he said also that the Fed isn't printing money right now. Do you guys believe that? Obviously, I mean, you're shoving a bunch of money in here that has to come from somewhere.
It's a lie. It's a complete lie, and he has to do it right now to cover his ass. I mean, that's all he's doing, because pretty much the bottom line of it, everybody knows he's doing it, but until they actually come out and admit it, they're just basically trying to protect themselves against the rest of the other countries, because they're pretty much screwing everybody else is what they're doing. Everybody else's currency has to go higher as long as we keep doing it, and nobody wants their currency higher. So it's they're basically out there doing it. The problem is I don't really understand why they just don't come out and say it. You know,
It's a confidence game.
right?
And I think, Bernanke came on 60 Minutes to try to make his case for why he's doing QE2. And like I was telling Andrew earlier, I think Mr. Bernanke is trying hard. I have issues with what he said last night in terms of.
But why keep trying? Why not just let it wash itself out? That's the problem.
I almost wish he would stop trying and force the fiscal authorities,
Right.
the president, the administration, Congress to do what needs to be done to fix these problems, to give people in this country some confidence in terms of their tax policies, in terms of fiscal stimulus, if possible. We know that the tax code, as Chairman Bernanke said last night, is a disaster. It's a mess. There's a lot of disincentives to invest out there right now. There's a lot of disincentives to hiring right now because of the uncertainty with the tax situation. And what new regulations can our left-leaning administration pile on businesses and investors in this country? And until they can do something, anything, whether it's the right thing or the wrong thing, people will not hire, people will not start new businesses, people will not invest in this country. And I feel bad for Chairman Bernanke to a certain extent because he's in this situation where he's sort of the last and best shining light out there, or the only shining light for any hope for the U.S. economy. And it's sad. It's very sad.
What about those tax cuts? I think it's this Friday that if they don't do anything with the Bush tax cuts, they kind of go kaput. I mean, is that something we need to keep around, try and help, put as much money in people's pockets as possible?
So now you're going to do QE2 and you're going to do tax cuts.
I mean, it's out there.
Yeah.
I mean, at what point in time is it just one? That's the problem I have. One is enough. Now, if you would have talked about tax cuts before all the QE stuff, I mean, like, okay.
I think the problem is it's a bunch of free money that's not really going into anything useful. It's not.
Well, that's the point.
Creation,
that's the whole point
right?
of the whole thing.
It's not creation.
That's why we're
so.
saying stop.
Right.
So, I mean, you got right now. I think the problem is I don't think they're actually buying bonds anymore. I think that game's coming to an end. I think they're going to go on to other things, stocks, real estate, REITs. I mean, I don't think they're going to keep buying 30 years and 10 years and 5 years and whatever.
Well, that hasn't worked
Right.
at all, and it's produced probably the biggest bear move in bonds that we've seen in the last couple of years.
Right.
At what point do they say enough? I don't know. We're not there yet. We've got auctions this week. We have the 3-year auction tomorrow. We have a 10-year on Wednesday, and we have a 30-year auction on Thursday. And I think this is the first 30-year that we've seen since QE2 has started. It will be very interesting to see how that bond auction goes Thursday. It will give us the next big move in the bond market here. We'll see. I'm obviously, you guys know, I'm leaning towards the bearish side here. The technicals on the bond market don't look very good. Again, we have a potential double bottom, but again, I don't believe that's going to hold up. I think the bonds are going to make new lows like the 10-year already has. I think it's just going to play catch-up here at some point, probably later this week.
Right.
Thursday and Friday are going to be very interesting days because Thursday's the bond auction. And then Friday, the Fed will announce its next QE schedule. We have buybacks every day this week except for Friday, which is when the new schedule is going to come out. So it'll be interesting to see how they're going to play that. Maybe they front load, some bond buybacks, try to save the bond market here. Who knows?
Are you interested in who's buying those 30-year bonds? Are you focused on that when it comes out? Is it China? Is it not China? Is it only the U.S.? Who is it?
Yeah, definitely. We have seen a marked cutback in the amount of foreign purchases of our bonds over the last couple months. Now, the data that we see from those things is often dated, but I think as China's tightening their own monetary policy here, I think that will prompt less buying of our debt and probably more buying of their own debt, as they're going to have higher rates coming there.
Okay. Now going overseas to Europe, last night Mohammed El-Arian of PIMCO kind of stated that he believes that Ireland and other countries might possibly leave the euro within 5 years. PIMCO, whatever he says, kind of has a little influence on the markets. It was posted in the Irish Times newspaper. We didn't see a huge reaction last night. We did see about a 50 pip sell-off in the euro. Do you guys think going forward this Europe stuff's going to creep back up? I know we kind of talked about it last time, but now it seems like it's kind of floating back in the picture a little bit.
It is, but it doesn't matter. I don't really think it's matter. I mean, it would be like us talking about Washington, that's going bankrupt. I mean, it's just, we all know what's out there, and it doesn't really matter. I think the big one is Spain. I think if that would be the next thing. I think Ireland's done. I think Greece is done. I think Portugal's done. I think it's out there. I don't think it really matters. I think Spain's kind of the big one. So if we kind of got a little glimmer of that Spain stuff last week, and you could see the market really cares about that. That's all I'm really concerned about.
Okay. You guys have any good areas or spots or anything you'd like in any of the markets you're watching?
Well, a lot of interesting, Friday's lows in the bonds is obviously very key. That 123, I want to say 21 to 26 area, there's the old lows there. We have a potential double bottom there. We want to watch that. I thought it was interesting last night when the euro currency rallied. It sort of stopped against the old lows at 133.44 to 133.41. Or was it 134 handle? I forgot. What was the high last night?
134.20.
Okay. So 134.41 is the old lows in the euro currency. Looks like a nice Elliott wave count on the way down there. As long as you don't overlap that previous low, we could see another bear move down in the euro here over the next couple days. We saw a lot of big shifts in open interest in the credit markets on Friday too. Big drop in front month euro dollar open interest. I think that was related to sort of the euro currency rally. People took off a lot of their short hedges. They thought that LIBOR could spike up as the euro was going down. Concerns about funding issues in Europe and here in the States. But as we saw sort of the euro currency rally and some of these fears abate, the euro dollars sort of lost some of their hedging short interest there in the front months. I think that's a little bit premature myself. I sent out another email this morning on the red D euro dollar, how it had bounced back up to this real important 99.35 to 99.37 area. I don't know about getting short right there. We've got a big expiry this Friday. The short D's 99.37 calls have the biggest open interest of any of the short D's euro dollar call strikes, and I think that'll cap the market a little bit here. I would actually look at buying some euro dollar puts here. I think the market's had a nice sell-off, and then we had a real little bounce back up. I think if Europe especially starts to have more problems, we're going to see some more LIBOR concerns. I think you could buy like this Friday expiry 99.25 puts, which are 10 ticks out of the money for like half a tick. Might be a kind of cheap lottery ticket trade.
Right.
That's about it right now, guys.
Anything over here?
E-minis, really been trading them actively lately, really been watching them. I think today if we can get a break below like 60 and a quarter, you got to be short. Risk basically above 22, which is today. And then big areas coming in, basically the 1200 area to 98.5. If we can break through there, then we should head back towards that 74 area. 74.5, basically 79.5. Oil markets, it's tough. I think we're stuck in between areas. We're just creeping towards those highs, and I think you got to stay long commodities. I agree with George on that. And saw silver $30 today, so
Yep.
So we pushed above $30 today on the silver, which is huge. Never thought I'd see that, but so commodities are rallying. Right before we walked out, though, we did see a dump back down in gold and silver, a little bit pushed back down, but we did see silver make above that $30. So long commodities I like, and short equities.
Okay. Once again, George Cavaligos from MF Global, Brian Tahako from TNT Group. Make sure to check out our websites, and here's to good trading.
Tomorrow, 3 p.m. Bloomberg, I'll be on live, so check that out tomorrow.
There you go. Thanks, guys.